Welcome to this week's video. In this week's video, I'm going to talk about the gain that you receive when you sell your home at a higher price than what you paid for it. And specifically, I'm going to talk about the tax consequences of that gain and how you can avoid any capital gains tax or significantly reduce that tax. Okay, let's get started. So how does a capital gains tax work? Well, it's a tax on the gain that you receive from the sale of your home and the difference between the sales price that you receive and the basis in your home. The basis is simply what you paid for your home plus any home improvements you may have added, such as maybe you added a new roof or you did some remodeling inside the home. That difference is the gain. Let's talk about strategy number one, which is a strategy that you can use every 2 years. If it falls within 2 years of the sale, you cannot use it. You're going to have to wait for that 2-year period. But let's say you qualify in that scenario and you can use this credit. What it is that if you're single, you can exclude $250,000 of that gain. And if you're married, it's $500,000 of that gain. In order to qualify for this, you have to have lived in that home, and it has to be your primary residence, and you have to have owned it. You have to be the owner 2 of the last 5 years, and those 5 years are preceding the sale of that home. That doesn't mean that you have to have owned the home for 5 years. It just means any 5-year period preceding the sale of that home, you've had to own it and lived in it for those 2 years. If you do that, then you can qualify for this exclusion. And also, you might be able to get an exception to this exclusion under certain circumstances. If you sell it for work, you may qualify depending on the circumstances, or if there's some kind of health issue or any unforeseen issues, it may qualify as well. So let's take an example. Let's say you bought a home 25 years ago for $200,000 and you made some improvements to the home of $75,000. That means that your basis in this home is the cost you paid initially and the improvements of $75,000 for $275,000. Let's say that you sold the property for $1.3 million. Well, if you're married, potentially $500,000 of that gain would be excluded, which leaves $525,000 of that gain as being taxable. So you can see $500,000 automatically right off the top is reduced, so you're able to significantly lower your capital gains tax. So strategy number 2 is to convert that property into a rental business. You're actually maybe possibly looking to buying another home, converting it into a rental business. By doing that, you then enjoy the benefit of the rental income, and you also defer that gain until you actually sell it. So in order to qualify for this, you would have to put your home up for rental, rent it to third parties, and it's a good idea to hold the property for at least 1 year. 2 years is better. And the reason for that is it demonstrates to the IRS that this is no longer a primary or personal home, and it's subject to being under the business rules for taxes. Well, now that this is a business property, the 1031 exchange rules come into play, and that simply allows you to exchange that property. You sell that property, and then you buy another property for more value, and that, depending on how the transaction is structured and how it comes out, will allow you to defer that gain on that original home until that other property is actually sold. For example, and you offer the property for rental to third parties, and you rent it for 5 years. Now the property is worth $1.65 million, and you decide, you know what, I want to exchange this for an apartment complex. And you go ahead and do that. You exchange that property for apartment complex. In fact, you decide that I'm never going to sell this property, and on death, transfer it to your kids. And in that case, the gain then would then be taxed under the estate. But having said that, in the estate, you may be able to utilize some of your exclusion to totally protect that gain. Therefore, you've never been taxed on the sale of that home or the transfer of that home. So you can see that would actually avoid taxes. Now the rules are complex, so it's not as simple as I'm making it sound. So always seek out a consultation from either myself or from another tax professional just to make sure. The third strategy is opportunity zone, and this is relatively new. This came from the Tax Cuts and Jobs Act. You take the gain when you sell that home and you put it into an opportunity fund. And what that allows you to do is to defer that gain that you received to a later date. And in this case, it's going to be 12/31/2026. It's the set date by the IRS or by the law that says at that date, now we're going to tax that gain. And so again, you're going to defer that gain. But what's great about this is that that money that you invested in this opportunity fund helps to lower that initial gain that you received on that property. Not only that, but if you hold on to that opportunity fund, you may potentially be able to avoid taxes on the gain that you receive from that opportunity fund's own investment. And that is if you hold that property over a certain period of time, which is 10 years. Let's take an example. You sell the home on 1/1/2021 and you have a gain of $575,000. And you fully invest that in an opportunity fund. Well, on 12/31/2026, it's time to pay the tax on that gain. And so you'd be able to pay the tax on the gain. You'd get a reduction in that gain of about 10%. It depends again on the scenario, but in this, for example, let's say it's 10%. And then on January 2nd, 2031, you sell that opportunity fund for $1.3 million. Overall, you're deferring that gain and you're able to exclude the gain on the $725,000 that you gained on that opportunity fund. So the last one is installment sale. And really what the installment sale does is it allows you, when you sell that property, to kind of be like the bank for that property. But let's say you sell it to a third party and you say, I'm going to go ahead and finance that over a period of time. Well, you would only recognize that gain based on the money that you received. And the benefit of this is that by only having to recognize that gain over the period of time based on the money you received compared to the total gain that you received, that helps possibly to keep you in a lower tax bracket and also avoid other things that may trigger depending on your income. So if you lower that gain, it lowers your income and that might help keep you in a lower tax bracket. You're spreading that $225,000 gain over 15 years based on the actual money that you receive. Now there's risk in this because you don't know whether you're going to get paid or not, but it is spreading it over a period of time or deferring it, if you will. So in summary, it's a good idea to invest some time up front if you're going to sell your home. If you're within the exclusion period, it doesn't automatically mean that you should just not worry about it. The rules are constantly changing, so work with a tax professional or we'd be happy to help you as well. So I hope this video was some help for you. If you have any questions, reach out, and if you like this video, thumbs up would be awesome, and it'd be awesome if you subscribe as well. Okay? Until next time, thanks for watching this video.